Hi there, I'm Lenata Wenzel. This podcast is about the capital allowances for small business corporations, as well as the capital allowance for manufacturing assets. We will firstly look at small business corporations. There are two special capital allowances for a small business corporation as provided for in Section 12E of the Income Tax Act. The first one is for plant and machinery used directly in a process of manufacture. These assets can be new or used, and the allowance is not apportioned. This means that the taxpayer claims the full allowance although the asset was used for only part of the year. The percentage applicable to this capital allowance is 100%, and it is claimed in the year that the asset is brought into use. So the full cost of manufacturing plant and machinery of a small business corporation is claimed in the first year. Let's look at an example. Assume your company has a year end of 31 March 2015 and it bought a manufacturing asset at 300,000 on 1 January 2015. So it's in the 2015 year that this asset was brought into use, and therefore you can claim the 100% allowance in the 2015 year. And therefore your full cost has been claimed. The second special capital allowance that a small business corporation can claim is for other movable assets. These are any assets used in the taxpayer's trade that are not part of the process of manufacture. For example, vehicles, furniture, and computers. The assets can be new or used, and the allowance is not apportioned. The cost is claimed over a period of 3 years. 50% in the first year, 30% in the second year, and 20% in the third year. Let's look at an example. It's the same year end. The cost of this vehicle is 150,000 and it was brought into use in my 2015 year of assessment. Therefore, I will use the 50-30-20 rule, and because it's my first year that I brought it into use, I will claim 50% as my capital allowance. If I look at another example, where I have the same year end and the cost is 150,000, but I brought it into use on 1 January 2014, in other words, in my previous year of assessment. Then you can see that I have claimed for it already in the 2014 year at 50%. Therefore, in my 2015 year that I am busy with, I will claim the second year allowance, which is a 30% allowance. This is why a timeline is very useful when you deal with assets, because you can clearly see that the asset was brought into use for the first time in 2014. Therefore, for my 2015 year of assessment, I know now that I can claim the 30%, not the 50%. So, these allowances that we've just discussed are applicable to small business corporations, and you do not consider Section 12C or 11E when calculating a capital allowance for a manufacturing asset or for other movable assets of a small business corporation. Now we are going to discuss the Section 12C capital allowance. You must first determine whether the business entity is a small business corporation. When it is not a small business corporation, then your next step is to determine the nature of the asset that you are dealing with. If this asset is plant and machinery used directly in a process of manufacture, then a Section 12C allowance can be claimed. This allowance can be claimed on new or used manufacturing assets, and it is not apportioned. The percentage applicable to this capital allowance depends on whether the asset is new or used. If it is a used asset, in other words second-hand, then 20% of the cost of the manufacturing asset is claimed every year for 5 years. The first 20% will be claimed in the year that the asset is brought into use. If the manufacturing asset is new or unused, then this asset is claimed over 4 years. 40% of the cost is claimed in the year that the asset is brought into use, and 20% of the cost in the following 3 years. Let's look at a few examples. If this manufacturing asset cost 100,000 and it was brought into use on 1 January 2015, and it is new and unused, this means that I will use the 40-20-20-20 rule. In other words, in my first year that I am bringing it into use, I will claim 40% of the cost as my capital allowance. Let's assume now that I have brought it into use in my previous year of assessment on 1 January 2014, and it is still new. In other words, I will still apply the 40-20-20-20 rule, but because this is now my second year my 2015 year of assessment, then I will only claim 20% in the second year. Now let's look at an asset which is also brought into use on 1 January 2015, but it is used. Now I can't apply the 40% in the first year. I apply the 20% for 5 years, and that is why I will claim 20% of the cost as my capital allowance for this asset. Another thing to take note of is the deduction of moving costs relating to assets claimed in terms of Section 12E and Section 12C. If the moving cost is incurred in the year that the asset is brought into use, then this amount is added to the purchase cost of the asset, and the total amount is claimed over the number of years that Section 12E or Section 12C prescribes. If we look at an example, let's assume the cost of the asset is 100,000 and moving costs were incurred when it was brought into use of 10,000. Then we will add the two amounts together, and the 40% allowance will apply to that total amount to get my capital allowance for this year. If the moving cost is incurred at a later stage though, for example in the second year, then the moving cost is claimed over the remaining period that the capital allowance for this specific asset can be claimed. If you look at an example of a manufacturing asset that is claimed over 4 years at 40% in the first year and 20 in the second, third and fourth year. Let's assume the moving cost of this asset was incurred in the second year. Then you can see that there are 3 years left that this asset can be claimed over. That's why I will claim the 10,000 moving cost over 3 years, divided by 3 years. So the total amount will be claimed over the remaining period that this asset is claimed for capital allowance purposes.